Welcome to Boom Bust. I'm Edward Harrison. Aaron Aid has the day off. Today's headline, student debt. The average 2014 graduate with student loans owes $33,000, according to an analysis of government data by Edvisors. That makes today's graduates the most indebted ever. As this graph shows you, debt is double the amount just 20 years ago, even after adjusting for inflation. In aggregate, the student debt load in the United States is now about $1 trillion. But wait, help is on the way. Just yesterday, President Obama signed an executive order capping payments at 10% of monthly income for millions of borrowers. Here's what President Obama said on the issue.
We are here today because we believe that in America, no hard-working young person should be priced out of a higher education.
The president also voiced support for Massachusetts Senator Warren's bill to cap interest rates on student loans. But here's what the president isn't doing. He isn't reducing debt principal payments. He isn't allowing debtors to discharge student loan debt in bankruptcy, and he isn't preventing student debt servicing abuses. Basically, what we see with student loans is what we saw with housing, a big increase in household debt, and a host of loan servicing abuses. The Huffington Post Shaheen Nasirapur has reported over the last year that student loan servicers like Sallie Mae illegally block payments from accruing to loans with the highest interest rates, prevent borrowers from learning of cheaper repayment options, overcharge active duty members of the military, violate discriminatory lending practices, push debtors into plans that increase their burden, and harass borrowers. If all this sounds familiar, it's because it should, because these are exactly the types of abuses that we saw in the mortgage market. Rather than crack down on these abuses, the Obama administration rewarded servicers for loan modifications under the now notorious HAMP program. And that's exactly what the Obama administration plans to do here, too. The administration fact sheet on, quote, making student loans more affordable says, quote, today, the department announced that it will renegotiate its contracts with federal loan servicers to strengthen financial incentives to help borrowers repay their loans on time, lower payments for servicers when loans enter delinquency or default, and increase the value of borrowers' customer satisfaction when allowing new loan volume. It sounds good on paper, but so did the mortgage modification programs. Monetary policy seems to be the only tool in the central bank toolkit. And so how central bankers conduct monetary policy will have major implications for our economy. Our next guest is Dr. Steve Hanke, who is a professor of applied economics at the Johns Hopkins University in Baltimore and a senior fellow at the Cato Institute. He spoke to Aaron earlier about Venezuela and hyperinflation, currency wars, and Federal Reserve policy. Hanke believes that Janet Yellen's monetary policy is schizophrenic. Aaron first asked Hanke to explain why. Here's what he had to say.
This comes from this separation between bank money and state money, of course, has been known but for a long time, and particularly in 1930, John Maynard Keynes wrote his treatise on money, which Milton Friedman thought was his best book, and I agree. And he had this separation between state money. State money is produced by a central bank, and we call it high-powered money or monetary base, or if you're looking at M's, it's M sub 0. That's state money. And that accounts for about 20% of the money supply, total money supply, broadly measured in the United States. The other chunk, the elephant in the room, is bank money. That's 80% in the United States, and that's produced by banks. Commercial banks produce this element of the total money supply. And I'm talking about M sub 4 as measured by the Center for Financial Stability in New York. That's a big, broad measure of money.
M sub 4?
So the reason I said it's schizophrenic is that most people say, oh, the monetary policy has been very loose. You know, since Lehman collapsed in 2008, the Federal Reserve's increased the state money by about 300%. and so it's loose. It is loose, but it's a small portion of the total. The bank money part has actually declined by about 14% since Lehman collapsed, and the reason that's declined is that we have all these new bank regulations, all these new capital requirements coming out of Basel in Switzerland. These are international regulations, and leverage ratios and liquidity ratios and capital ratios. You name the ratio, it's getting tighter and tighter, the noose around banks, and so banks haven't been lending much money. They haven't been expanding the money supply. They've been reducing it.
Right, but it doesn't mean they haven't been doing well themselves, which is kind of an interesting point. Now, frequent Boom Bust guest Jim Rickards says that the currency wars, they've erupted. And regarding the Fed, his view is that the Fed pushes interest rates to artificially low levels, causing investors to seek yield in other currency areas, which then strengthens local currencies as hot money flows in. Now, with the Fed tapering, the reverse seems to be happening. So do you think the so-called currency wars are real?
Well, the phenomenon that you just described, that Ricketts described, has happened. I wouldn't call it a war, but I think it's just muddled and misguided thinking on the part of the Federal Reserve, the Bank of Japan, and the European Central Bank. All these central banks have pushed their interest rates down to virtually zero, and so what happens, everyone wants to get a yield, wants to get a return, and so the hot money flows out of the United States and it goes into countries where they can get a higher nominal interest rate, like Turkey, for example. And the total amount of money that's flowed out, the so-called carry trade, they call this the carry trade. You borrow it at almost nothing and invest at some more attractive interest rate. This carry trade, it amounts to about $2 trillion. It's enormous. It has, unlike what you said, Aaron, it hasn't stopped, because it will stop only when U.S. interest rates go up. That's the part of the tapering conversation that is key for the carry trade. Is as long as interest rates stay near zero or very low in the United States, the carry trade will remain. But once interest rates start going up and the carry trade unwinds, it's going to be very destabilizing in some of these emerging markets, particularly places like Turkey, that they probably accumulated, I think, at least $350 billion in carry trade money in Turkey.
Do you think the recent emerging markets crisis was a result of currency volatility, or are there other more important factors at work here?
Well, I think the currency volatility starting in June of last year, when Fed Chairman Bernanke at the time mentioned the word taper, it really shook the markets up. I think they were caught wrong-footed, and they were wrong, because I don't think the Fed's going to increase interest rates very soon. And the reason why, we're still in the middle of the Great Recession. The aggregate demand, not measured in nominal terms in the United States, is only growing at about 2.8%. And the trend rate of growth since 1987 in that aggregate demand, or final sales to domestic purchasers, is 5%. So we really never have come out of the recession. That's why we're growing very slowly, and the money supply, the total money supply now, is only growing, given this Center for Financial Stability M4 Divisia measure, by only about 2.6%. Very slow money growth, very slow aggregate demand growth, and this whole idea that the Fed is going to be tapering anytime soon, I think is just wrong. The economy is just weak.
Now, I want to return to Latin America for a second. Venezuela has the highest inflation in the world, but it still has a long way to go before it reaches hyperinflation. Now, what would help them avoid this kind of fate? And also, can you quickly describe what causes hyperinflation? If it's not hyperinflation today, what will it be?
Well, number one, hyperinflation, just to be very clear, is an inflation rate that's over 50% per month. So Venezuela isn't even close. My most recent estimate of the implied inflation rate in Venezuela is about 175%. The official number is about 57%. So again, you have lying statistics just like you do in Argentina. But so 175% a year is a long, long way from 50% per month, which you'd need for hyperinflation. So that's one point. Now, the second point is what causes hyperinflation. There have been 56 hyperinflations in world history. And the hyperinflation is caused because the government is spending a lot of money, and they're not collecting any taxes, and they're not in the bond market. They can't borrow from anyone. And so what do? They go to the central bank and hold a gun at the head of the central banker and say, print money. Finance the government.
That was Dr. Steve Hanke, professor of applied economics at the Johns Hopkins University. Time now for a quick break, but stick around because when we return, we bring you more on monetary policy with Professor Scott Sumner, one of the most vocal proponents of market monetarism and nominal GDP targeting. And in today's Big Deal, I'm sitting down with Lee Camp, the host of Redacted Tonight. We're talking about the increasing divide between the rich and the poor. So stay tuned. And here, before we go to the break, are the closing numbers at the bell.
Are you like me? You want your comedy news with some teeth? Want your comedy news to be a bare-fisted, no-holds-barred fight to the death? Like a truth vampire biting into the necks of the corporate elite and the billionaire freaks while they're going, make it stop! Well, that's what you get with my new show, Redacted Tonight.
Is that too much? I think that's too much.
What are your thoughts on what's been going on in Washington?
Well, it's a mess, Larry. I mean, the whole country is being scoffed at and laughed at.
Enough is enough.
The media, the candidates, the corporatocracy. Covering issues that actually affect you and me doesn't do too much for ad revenue.
Biotech agriculture giant takes on a 76-year-old American farmer based in Indiana.
How much fallout do you think this is going to create for the CIA? Do you think this is what's triggering the crisis?
America's the largest economy in the world. It's also the largest debtor nation in the history of the world.
Breaking the set is mostly about alternatives to the status quo, but one that gave real alternatives a voice.
One minute they were working toward the American dream, the next they were just trying to survive the night. It's time for Americans and lawmakers in Washington to wake up and start talking about the real causes of poverty in America.
Policymakers predict bubbles. Can they take steps to pop them? What role should monetary policy have in markets? Now, continuing our exploration into all things monetary, we explore market monetarism with Scott Sumner, an economics professor at Bentley University and a vocal proponent of market monetarism. Aaron spoke with Sumner earlier and first asked him to explain what the Fed should have done after the first oil shock. After a deep recession, the economy was going gangbusters by early 1975. So she wanted to know, what would market monetarism prescribe? Here's what he had to say.
There's really two problems that existed at that time. First of all, the trend rate of inflation and nominal GDP growth was simply too high during the 1970s. So we should have had a slower growth in the money supply, a slower rate of inflation, slower trend in nominal GDP. The second thing, though, is the actual shocks to oil prices. And with nominal GDP targeting, you do allow a temporary spike in inflation when there is a severe oil shock, because that sort of cushions the blow on unemployment. Now, I know that sounds bad for people worried about inflation, but remember, if we're targeting nominal GDP growth at 5% on average, we're only going to have about 2% inflation on average. So the years where inflation is higher than normal, like during an oil shock, will be offset by years when it's lower than normal. But again, I reiterate, the big problem in the late 60s all through the 70s was not just the oil shocks, but we let the trend rate of inflation get way too high. So instead of going from 2% to 4% inflation, we sometimes went from 10 to during the oil shock years.
Could we have a severe recession without the 2008 financial crisis, in your opinion?
Yes, we could have. In fact, we have had severe recessions in the past without oil crises, or I'm sorry, financial crises. But what I think happened there was the financial crisis was sort of the trigger, but the deeper cause was a failure of monetary policy. That is, monetary policy didn't sufficiently boost expectations for nominal GDP growth. It wasn't stimulative enough. So we sort of, it's like a cold turning into a pneumonia. The financial shock was the cold, and what happened is it spiraled into what's called a secondary deflation. That is, once nominal GDP started falling, then the original shock got much worse than it needed to be. So probably a mild recession was almost inevitable in 2008, but it became much more severe than it needed to be because of this failure of monetary policy.
In the wake of the 2008 financial crisis, the Fed's Jeremy Stein has basically led the charge on making financial stability a key goal of the Fed and Fed policy. What do you make of these efforts?
Yeah, I think that's really misguided because we simply don't know how to use monetary policy to promote financial instability. I mean, one thing we do know is that an unstable nominal GDP will tend to create financial instability. Throughout history, whenever nominal GDP has fallen sharply, you tend to get a debt crisis. Now, when we've tinkered around with trying to do things like popping asset price bubbles, it generally hasn't worked very well. We're not very good at figuring out when to do that. They actually tried to pop a stock market bubble in 1929, and what's kind of odd about that is they succeeded in popping the stock market bubble, but the ricochet effects in the economy were devastating, and we went into a depression due to a tight money policy basically in 1929. So we really need to be careful. I think if the Fed focuses on the macroeconomic goal of stable nominal GDP growth, which should provide for relatively low inflation and a good path of real GDP, then what you do is you look at the financial system, and if there's flaws in it, you deal with those through regulation, not trying to use monetary policy to sort of fine-tune the financial sector. It's simply not very good at doing that.
Scott, I understand that you don't believe financial bubbles exist. Can you explain whether high asset prices signal a bubble?
Okay, that's a tough one to explain because I know there are a lot of events that look like bubbles to most people. But what I believe is it's very difficult to sort of second-guess the market in real time. So if you look at the track record of people that sort of put forward the bubble hypothesis like Robert Shiller, even they tend to have difficulty pinning down when stocks are overvalued or undervalued. And so I think what happens is when there's a big run-up in prices, let's say housing prices in America up to 2006, and then they collapse, people will retrospectively say it was obviously a bubble. But you know, there was also a big run-up in house prices in Canada, Britain, Australia, New Zealand, and so on during the same period as America, and they didn't collapse in any of those four countries. So we had no way of knowing in 2006 that America would be the one of those 5 countries where prices would fall sharply. So I think it's misleading to try to sort of time bubbles or guess when bubbles are occurring, especially if you're public policy makers like the Fed. It's sort of fun to do as an investor, of course, but I'm a little skeptical that policymakers can do anything useful with bubbles as an idea.
But Scott, wasn't there a problem in the UK in the housing market? We saw that during that time, no?
There was some problem, but the housing prices in the UK basically went sideways after 2006. And they took a little dip and then came back up. But the US was really different. We fell about 30% or a little more after 2006. The other 4 countries I named either went sideways or even a little bit higher in the case of Australia, for instance. So if you just plot the graphs of those 5 countries, the US is really the outlier. We think that the British crisis was bad because the banks suffered there quite a bit, but the housing prices actually are comparable today or even a little higher, I believe, in Britain than they were back in 2006. So they did not have the house price collapse that we did, although they did have severe banking problems.
Do you think of monetary policy as a whole as a first port of call in terms of financial stability or a second best option?
You know, I think monetary policy is something that you're going to have. So it's not a question of do you use it or not use it. you try to come up with a policy that does the least amount of harm. Obviously, the fundamentals of the economy are what's important in the long run, and printing money can't address fundamental problems. So you want to have a stable monetary policy that doesn't make things worse. So rather than think about solving problems with monetary policy, I think in terms of a rule that will have stable growth in nominal GDP and will avoid creating problems. And the two big problems you don't want to create are highly unstable labor market with swings in unemployment, and you don't want to create a very unstable financial system, which you get with a crash in nominal GDP leading to debts being defaulted on. So you want to avoid problems more than sort of solve them with monetary policy.
Scott, we only have 1 minute left, but I want to ask you something very quick. Now, I want to read you a quote very quickly. Inflation is always and everywhere a monetary phenomenon in the sense that it is and can be produced only by a more rapid increase in the quantity of money than in output. Now, that's a quote from the late Milton Friedman, the Nobel Prize-winning father of modern monetarism. Now, tell me about the ideas from Milton Friedman that you find most captivating. And I'm sorry we only have 60 seconds, but I'd love to hear them real quick.
Yeah, well, I believe inflation is always a monetary phenomenon, but I think he defined it monetary a little too narrowly. So he looked only at the supply of money and how increases in supply of money can lead to inflation. But changes in the demand for money, or what some people call velocity, the speed at which it's spent, can also lead to inflation. And so what market monetarists try to do is not just have the money supply grow at a stable rate, but have the money supply times velocity, which equals nominal GDP, have that grow at a stable rate. In other words, when there's more demand for money, like during a financial crisis, the Fed should supply more, but just enough to keep total spending in the economy grow at a stable rate.
Right.
So I think he had the basic idea right, but needed to fine-tune it a little bit.
That was Scott Sumner, economics professor at Bentley University. Now, time for today's big deal. Big deal time. In today's big deal, I'm joined by Lee Camp, the host of Redacted Tonight here on RT. So there seems to be a modern tale of two cities in our modern globalized world. And our first story has to do with the increasing tone deafness society uses with the have-nots. Apparently, luxury flats in London have installed homeless spikes outside their door in order to prevent homeless people from sleeping there. One man named Peter is quoted in the Telegraph saying, "But would you want homeless people outside your door?" Charming. So, Lee, do you think this is an anomaly, or is this just the sort of reaction that we get in the kind of world that we're living in today?
Yeah, I think, sadly, it is not an anomaly. And furthermore, you know, now we're treating the homeless like pigeons. Why stop there? Why not go to cockroaches, you know? Maybe just leave jars outside with bedding inside. Once they get in, you screw on the top. I mean, it's just, it's preposterous. It's a terrible way to treat human beings. You know, and this is the egregiously wealthy, like the most wealthy, and they can't just stop at knocking people down. They then have to make sure and kick them while they're down. So that's what these spikes do. They're the kicking. You got to make sure. That's a key ingredient, the kicking while you're down.
You know, when I read the story, I was thinking, you know, if maybe if I could get like a big mattress, then the spikes wouldn't bother me if I was sleeping there. But it's amazing that people had the reaction that the individual did there, Peter. Let me give you another story actually that's on a similar thing. Let me get your take on that. It's slightly different, but it has to do with tone deafness and a disregard for the voiceless. Now, apparently, the Los Angeles City Council approved a resolution a few months ago to push for legislative or administrative action to halt the Trans-Pacific Partnership's fast-track process in Congress. So my question to you is, now, of course, LA isn't part of that negotiation in the first place, so it's unclear what kind of government action that they could take as a local government to prevent trade deals from going through. But what's your take on what's happening there?
You're absolutely right. Los Angeles is not part of the negotiations. You know who else isn't part of the negotiations? The American people. No one, even our Congress people, aren't part of the negotiations. This is the largest trade deal mankind has ever seen, and it's being decided by 600 corporate lobbyists. Like, in order for a congressperson to go see the bill, they have to make an appointment. They get like an hour. They're not allowed to bring anyone, not allowed to bring a trade specialist, not allowed to bring a pen or paper, cell phone, nothing, and they have to to go through, what, a 1,400-page document. Most of what we know about it is from WikiLeaks. I mean, it's atrocious. And basically, Alan Grayson did go to see it, Congressman Alan Grayson, and said it cedes our sovereignty to corporations. So.
Right.
That, you know, the right wing loves to call Obama anti-American. There's nothing more anti-American than giving away sovereignty to corporations.
I agree 100%. Now, these trade deals have been relatively secretive, haven't they?
Yeah, incredibly secretive. I mean, it is 600 corporate lobbyists. And what's funny is Obama, actually, there's clips of him speaking in 2008 saying, you know, the problem with NAFTA, the problem with our last big free trade agreement, it was decided by corporate lobbyists. And here they are, doing it all over again.
Right. Well, Lee, you know, we're running out of time here, but I wanted to know, you have a comedy show that you're working on. Are these the kind of issues that you're talking about? Are you going to discuss any of that? What kind of comedy are we looking at?
Yeah, our show is just 2 weeks old. It's in its infancy. Redacted Tonight. It's a great new show once a week. But yeah, we're covering those issues. We're covering some interesting issues on fracking, and we just covered last week. There was an amazing video of General Petraeus being introduced as fighting wars for oil. They didn't know they were introducing him in the wrong way. You're not supposed to say that, right? That's a secret. And he just accepts the applause. And that was on our last episode. It's all online. But yeah, we're a hard-hitting comedy show.
Well, that's good, Lee. Is it every week on Friday at 8 o'clock, is it?
Friday at 8, reruns at 11:30, and it's all at youtube.com/RTAmerica or Hulu.
Can you give us a sneak peek of what's coming up?
Yeah, we're covering all those stories I mentioned, and then, let's see, we're covering robot wars. You know, a bunch of Peace Prize winners, former Nobel Peace Prize winners, have come together and said, we need to stop autonomous robot killing machines before they start, because we're headed there, right, with the drones and everything. We are getting closer and closer to Terminator 2. And literally, these Peace Prize recipients came forward and said, let's put a ban on these things before they get going. And, you know, I think it's crucial. But so we'll be hitting on that. As you can imagine, there's some comedy in there.
Good stuff. I'm looking forward to it. That's all for us for right now at Boom Bust. Thanks for watching, and we'll see you tomorrow.